Is the biggest crypto rally of the decade about to begin? Over the next 3 months, markets could shift faster than anyone expects. Here's why: inflation is cooling, rate cuts are here, and global liquidity is starting to rise again. That combination has triggered some of the largest bull markets in history, but this time, something even bigger is brewing. The setup is aligning not just for stocks, but for crypto, and it's happening in real time. Cathie Wood, one of the most outspoken innovation investors on Wall Street, believes we're moving from a slow recovery into a full-blown productivity boom. She's positioned her funds in the assets she thinks will lead it: Bitcoin, Ethereum, and Solana. And the macro data is now backing her up. In this video, we're going to break down why Cathie Wood and other top analysts believe the next 3 months could catch everyone off guard, how global liquidity is quietly setting up the next major leg of this bull run, and why those who wait for confirmation might end up watching from the sidelines as Bitcoin, Ethereum, and Solana begin their next vertical move. And before we jump into it, just a quick reminder, only a small percentage of you watching are actually subscribed. If you're getting value from the videos, hit that subscribe button. It's free, it supports the channel, and you can always change your mind later. Now, let's begin.
I think we're going to have a boom in economic activity. That first one, the manufacturing structures, is just for 3 years. The other ones have been made permanent. And so this takes our effective corporate tax rate in the United States, not statutory, that's still at 21, but the effective tax rate for the next 3 years at least is going to be roughly 10%, one of the lowest in the world. So I think we're in for some very good times. We think we're moving from a rolling recession into a recovery, and then into a productivity-driven boom in activity.
Cathie Wood believes the next 3 months could surprise almost everyone. She says the United States is moving into a new phase of growth that most analysts are still missing. According to her, the combination of tax incentives, manufacturing investment, and technology could create a burst of productivity that drives both the economy and the markets much higher. She points out one major reason for optimism: the effective corporate tax rate in the US has quietly dropped to about 10%. While the official rate is still 21, new policies supporting factory construction and research spending have lowered what companies actually pay. That means businesses can keep more of their earnings, reinvest faster, and expand more aggressively. For Cathie, this setup looks like the beginning of a multi-year boom. She explains that what many call a recession over the last year has really been a rolling slowdown. Certain parts of the economy slowed down one at a time, housing first, then manufacturing, then retail, but they never collapsed altogether. Now, those weak spots are beginning to recover. Companies have cut costs, adapted to higher rates, and invested in automation. Consumers are still spending, and inventory levels are coming back to balance. When all of those factors align, history shows that productivity rises sharply. Cathie compares this moment to the early 1990s when the internet began spreading through business and transformed how companies worked. That period brought years of strong GDP growth and stock market expansion. She believes today's mix of artificial intelligence, robotics, and advanced manufacturing could have a similar impact. Instead of just relying on new money printing or government spending, this growth would come from technology making people and machines far more efficient. The key, she says, is that most traditional investors are using outdated models. They expect growth to move slowly, step by step. But innovation doesn't move that way. Once adoption begins, it accelerates. Tools like AI, machine learning, and automation are now being applied in nearly every industry at once. Productivity data from 2024 and early 2025 already shows a sharp jump in output per worker, something Cathie believes is only the beginning. She thinks the next bull market will be built on this wave of efficiency and innovation. Even if interest rates stay higher than before, she says it will not stop the rise of new industries. Lower taxes and smarter technology will outweigh those headwinds. And that belief in innovation shows up most clearly in how she invests, especially in her growing focus on crypto.
One of the reasons we did not choose to invest in one of the Ether ETFs is, at least as of now, they will not be allowed to stake. And we think staking for yield is a very important part of the Ethereum story. We were having a lot of trouble, therefore, getting access to Ether in our portfolio. So when Bitmine immersion came along, we thought that would be a great opportunity after it sold off significantly following the burst. We did take our position. And same with Soulmate. We have a lesser exposure to Solana, but we now have exposure to the big three: Bitcoin, Ether, and Solana. And we think all three are going to play an important role.
Cathie Wood's optimism about the economy connects directly to her confidence in crypto. She calls Bitcoin, Ethereum, and Solana the big three networks that will shape the financial system of the future. Each one plays a different role, and together they represent the foundation of what she calls the digital economy. Bitcoin is the anchor. She views it as the digital version of gold, an asset that holds value regardless of central bank policies. As inflation pressures fade and global liquidity rises again, Cathie expects investors to return to Bitcoin as a safe and scarce asset. She has repeated many times that Bitcoin is not just a hedge, it is becoming the financial base layer for the new digital world. Ethereum, in her view, is where most of the real innovation happens. Its network allows decentralized applications, tokenized assets, and staking for yield. However, the current US-approved Ethereum ETFs do not allow staking, which removes one of the most valuable parts of the Ethereum story. For Cathie, that limitation makes those ETFs less attractive for long-term investors. Instead, ARK Invest gained indirect exposure to Ethereum by buying into companies that benefit from its ecosystem. One of those is Bitmine Immersion, a firm focused on energy-efficient mining and computing infrastructure. When its price fell sharply after the 2024 correction, Cathie saw opportunity and added to the position. She also took smaller exposure to Solana, which she believes offers faster and cheaper transactions while still benefiting from the same wave of blockchain adoption. Cathie calls these three, Bitcoin, Ethereum, and Solana, the building blocks of the next financial era. Bitcoin stores value, Ethereum powers applications, and Solana enables scale. Together, they form the base of the digital economy she expects to grow rapidly as AI, automation, and decentralized networks start working together. She believes these technologies will merge over the next few years, allowing capital, code, and creativity to flow freely without relying on traditional middlemen. Critics often say Cathie moves too early, but she sees that as a strength. Being early means being prepared before the crowd arrives. She calls it conviction through research, not speculation. Her focus remains on long-term trends, and she expects institutional investors to follow once regulations become clear and the market matures. Next, we'll break down why the coming 3 months could be the most bullish period of the entire cycle, how global liquidity, rate cuts, and market momentum all point to a surge that almost nobody is ready for. And if you want to stay ahead of these signals and know exactly when the market's heating up or when it's giving you those rare buying windows, I break it down every day in the Crypto Nutshell, my free 5-minute daily crypto newsletter. It's built to give you quick, actionable insights so you can make smarter decisions without spending hours buried in charts or headlines. You'll get clear signals on when to buy, when to take profits, and the latest news that could move markets, all delivered straight to your inbox. Just click the first link in the description, enter your email, and you're in.
If we look at this chart of the US stock market performance following rate cuts, the difference is striking. When cuts happen during a recession, stocks fall about 10% on average in the following year. When cuts take place outside of a recession, markets instead tend to rally by roughly 15%. And given the strong correlation between US equities and Bitcoin, this same principle likely applies for Bitcoin. With the world's biggest central bank now cutting rates, it's going to mechanically put upwards pressure on this chart of global liquidity. And that, in our opinion, is a significant catalyst that's present for Bitcoin today. Because if we put the chart of Bitcoin on top, we see that the two lines have quite a close relationship. Periods when global liquidity is moving higher, Bitcoin tends to rally. And times when liquidity was contracting, like here in 2014, 2018, and 2022, Bitcoin also experienced sharp drawdowns. In fact, this global liquidity chart can help us anticipate where Bitcoin will be in a few months from now.
Across global markets, the signs are becoming impossible to ignore. Central banks have started cutting rates again, and history shows that when those cuts happen outside of a recession, it almost always marks the start of a major bull phase. Analysts have compared decades of data on US stock performance following rate cuts, and the pattern is consistent. When cuts are made during a crisis, the market struggles, falling around 10% over the next year. But when those same cuts come while the economy is still expanding, the opposite happens, stocks rally an average of 15%. That difference matters because we're currently in the second scenario. Growth is holding steady, unemployment remains low, and inflation is cooling. This is exactly the kind of setup that creates large-scale rallies in risk assets. Lower interest rates make credit cheaper, reduce pressure on debt markets, and lift asset prices as liquidity flows back into equities, crypto, and tech. Investors with capital on the sidelines suddenly have an incentive to move it, and that shift is what pushes markets into acceleration mode. In previous cycles, this same environment has sent Bitcoin soaring. It's easy to forget that Bitcoin thrives not just on speculation, but on liquidity itself. Every major rally, 2013, 2017, 2021, lined up with periods of expanding money supply and easier monetary policy. The Federal Reserve's pivot this time around is already showing up in liquidity data, and that has huge implications for what's coming next. When we plot Bitcoin's price against global liquidity, the two charts almost move in sync. Liquidity acts as the tide, and Bitcoin is the ship that rides it. When liquidity drains, prices fall. When it rises, Bitcoin rebounds sharply. That's why these early cuts are so important. They're not a reaction to collapse, but a preemptive adjustment designed to stabilize the economy. And that makes them the most bullish kind of cuts possible. But the real insight comes when we shift the chart forward and see what usually happens next, because Bitcoin rarely moves at the same time as liquidity. It moves just after.
Now, if we take this chart of global liquidity and shift it forward by about 3 months, something very interesting happens. Bitcoin doesn't just closely track the direction of liquidity, it tends to follow it with about a short lag. This is a relationship we also highlighted back in April of 2025, when Bitcoin was still trading near $80,000 and investors were calling for a bear market. At that point, global liquidity had already bottomed and was turning higher, which kept us constructive on Bitcoin. Not long after, Bitcoin rebounded sharply and pushed to new all-time highs.
If we take the chart of global liquidity and shift it forward by about 3 months, something fascinating appears. Bitcoin doesn't just move in the same direction, it follows liquidity with a short delay. This lag has shown up consistently over the last decade. In early 2015, liquidity bottomed, and 3 months later, Bitcoin began a long climb that led into its 2017 explosion. The same thing happened in 2019 and again in late 2023. Each time, liquidity started turning up quietly before Bitcoin made its move. This pattern held again earlier in 2025. When Bitcoin was stuck around $80,000 and many traders were calling for a bear market, global liquidity had already bottomed. It began trending higher, and 3 months later, Bitcoin rallied to new highs. That is the same setup we're seeing now. Liquidity is once again pushing upward, and Bitcoin has not yet fully responded. Based on previous behavior, that response usually begins within 1 quarter, and that means the next 3 months could be the spark that sends the market to its next major target. Several factors are aligning with this setup. First, US money supply growth has turned positive again for the first time since 2022. Second, Asian and European central banks are injecting stimulus to defend against slowing exports and weak industrial output, adding even more liquidity to global markets. And third, risk appetite is returning. Institutional funds that once parked cash in short-term bonds are now rotating back into equities and digital assets. This combination is the reason many macro analysts are turning bullish on Bitcoin again. Liquidity expansion doesn't just support crypto, it lifts everything tied to growth and innovation. It's the same mechanism that powered tech stocks during the early 2000s and the same dynamic that drove the 2020 recovery rally. Bitcoin happens to respond faster and harder because it's the most sensitive asset on the risk curve. When money becomes cheaper and more abundant, Bitcoin prices move first. And the direction of that move, if history is any guide, is now pointing straight toward the 6-figure zone.
Today, liquidity is once again signaling a bottom in Bitcoin over the coming weeks, with the setup pointing to a move toward the $170,000 region by the end of 2025. Of course, this isn't a guarantee. As you can see, Sometimes Bitcoin tends to overshoot, like here, and sometimes it falls short, like here. However, with the Fed cutting rates, as far as the labor market doesn't break, we believe that reaching the 150,000 to 170,000 region by the end of 2025 is a real possibility.
Current models built on liquidity data are now projecting that Bitcoin could reach between $150,000 and $170,000 by the end of 2025. That estimate comes from aligning global liquidity growth with previous market responses. In each of the last 3 cycles, Bitcoin's price roughly matched or slightly overshot the rate of liquidity expansion. With the Federal Reserve easing and balance sheets expanding worldwide, the setup looks remarkably similar to the early phases of those rallies. Of course, there's never a guarantee. Sometimes Bitcoin overshoots its target like it did in 2017, and other times it comes in below expectations as in 2021. But the direction has always been the same. Liquidity rises, Bitcoin follows. With the Fed cutting rates and inflation trending lower, the macro pressure that held crypto back in 2022 and 2023 is fading fast. Energy prices are stable, tech productivity is improving, and the supply side of the Bitcoin market is tightening after April's halving. That's a rare alignment of fundamentals and macro forces. Every piece of data points to a market preparing for a fresh run. Exchange balances keep falling, showing that long-term holders are pulling coins off platforms. Spot ETFs continue to see net inflows week after week. Mining companies are cutting costs and holding reserves rather than selling. Each of these signs reflects growing conviction that higher prices are ahead. When combined with rising liquidity, the picture becomes clear. A powerful rally window is opening and it could begin any moment. The next 3 months are especially critical because of that 3-month liquidity lag. What we're seeing now in the data is the fuel. The ignition usually happens shortly after, and given that Bitcoin tends to move violently once momentum builds, small moves can quickly turn into full-blown breakouts. Analysts watching liquidity and rate cycles are calling this a pre-run phase, the calm before acceleration. Stocks are showing similar behavior. Quiet strength, steady accumulation, and a lack of panic even on red days. All of these are early ingredients of a major market expansion. If Bitcoin mirrors previous post-cut cycles, it could enter the steepest part of its rally before the end of the year. And that's exactly what the liquidity charts are suggesting. The market may not be ready, but the setup is already in motion. Anyway, guys, that's all we have for today. Thanks for watching, and I'll see you all in the next video.